Welcome back to the deep dive. Today, we're going to unpack the Q3 2025 results for Stryker, the medtech giant. We've got the earnings call transcript, the press release, basically all the raw data.
And our job really is to cut through that data fog for you.
Oh,
We want to pull out the core story here, figure out what's driving their growth and what their strategy looks like, especially around things like robotics and M&A.
okay, let's jump right in then. The headlines look, well, pretty impressive. Organic sales growth was 9.5% for the quarter.
Right, 9.5%. And what's really striking about that number is the comparison. It's against a super strong Q3 last year, which was what, 11.5% growth.
Exactly. So holding your double digits against that comp is significant.
It really is. And you couple that 9.5% organic growth with 11.1% adjusted EPS growth, it paints a picture of real strength. Adjusted EPS hit $3.19.
And they managed this despite some serious headwinds, right? I think tariffs were mentioned quite a bit. We'll get into that later, I assume.
Definitely. Those tariff costs are a factor, but the underlying performance is strong.
So let's lay out the Q3 foundation. Total net sales were up 10.3%, hitting $6.1 billion.
And crucially, look at the margins. Adjusted operating margin expanded by 90 basis points. That brought it up to 25.6%.
90 basis points. That's almost a full percentage point gain in efficiency in just one quarter.
Yeah, significant. And interesting, too, pricing only gave them a small lift, about 0.4% favorable impact on sales.
So 9.1% of that growth came from just more volume, more units sold, better operational leverage.
Pretty much. It suggests their products are winning on merit on technology, not just price cuts. People want their stuff.
And that demand seems pretty widespread. The U.S. was strong, obviously 10.6% organic growth there.
Right, U.S. led the way, but international wasn't slow either, grew 6.3% organically.
Any specific areas called out?
Yeah, they mentioned solid contributions from South Korea, Japan, and some emerging markets too. So balanced growth, really.
Okay, and all this strength, it seems, has made them pretty optimistic about the full year. They raised their guidance.
They did. The new expectation for organic net sales growth is 9.8% to 10.2%. And adjusted EPS is now targeted between $13.50 and $13.60.
And they're sticking to that big margin goal, too.
Yes, they reaffirmed their commitment to hitting a second straight year of 100 basis points of full percent of adjusted operating margin expansion for the full year.
Raising guidance while also calling out increasing tariff headwinds. It does make you wonder, are they being maybe a bit too bullish, or is the demand, particularly for capital equipment, just that strong?
I think it signals confidence in that underlying demand. They wouldn't stick to that 100 basis point margin target if they didn't see strong demand and operational wins offsetting those costs, especially in key areas.
Like orthopedics, that seems to be a major growth engine.
Absolutely. Let's dive into ortho. Double-digit organic growth overall, 11.4%, and even higher in the U.S. at 12.9%.
Wow. What's driving that?
Well, if you actually back out the spinal implant business they divested, the growth was even slightly higher, 12.5%. But the real star, the consistent driver, is Mako.
The robotic surgery platform. Still.
They had their best Q3 ever for Mako installations, both in the U.S. and internationally.
It's been around for a while now. Why is Mako still such a critical piece for them? It's more than just selling the robot itself, I guess.
Oh, absolutely. It's about the ecosystem. They highlighted high utilization rates for Mako systems. When a hospital buys or leases a Mako, especially if they buy it outright with cash, which we'll touch on later, they're buying into the whole Stryker system.
Meaning the implants, the disposables, the service?
Exactly. High utilization means high recurring revenue from those associated products. It cements their #1 spot in U.S. hips and knees. It builds a competitive moat.
Which explains the strong implant growth figures. U.S. knees up 8.4%. U.S. hips up 8.7%. That's directly tied to Mako adoption.
Directly tied. And it's accelerating because Mako's capabilities are expanding. They mentioned using it now for more difficult primary hip cases and even for hip revisions.
So it's tackling more complex procedures, widening its use case.
Right, expanding the market even within hospitals that already have the system.
And it wasn't just joints doing well in ortho, right? Trauma and extremities also looked strong.
Very strong. 13.2% organic growth in the U.S. That was driven by continued momentum in shoulder procedures and their Pangea plating system for core trauma cases.
And all this seems to tie into a bigger trend. They mentioned the shift to ambulatory surgery centers, ASCs.
Yes, that's a huge tailwind for them. Management loves the ASC trend because Stryker can offer the entire package.
You mean not just the implants, but the capital equipment like Mako, the instruments, the waste management systems, everything an ASC needs to set up shop for ortho procedure.
Precisely. They become a one-stop shop for these efficient, high-volume centers. It simplifies everything for the ASC.
And more procedures are moving that way?
Seems like it. They mentioned total shoulders are increasingly done in ASCs, and maybe even total ankles down the line. Stryker is perfectly positioned to partner with ASCs making that shift.
Okay, so orthopedics, powered by Mako, and the ASC shift is clearly a core strength. Let's switch over to the med-surg and neurotechnology side. How did that segment perform?
Still very solid. High single-digit organic growth overall, 8.4%.
Any standouts within that?
Definitely. The U.S. vascular business was on fire, grew 13.4% organically.
13%. Wow. What was behind that?
New products, mostly.
Mm-hmm.
They called out 2 recent launches specifically, the Surpass Elite Flow Diverting Stent and the Broadway Aspiration System. These are for neurovascular procedures, like stroke treatment.
So cutting-edge tech driving adoption in a critical care area.
Exactly. It shows they're hitting the mark with innovation in high acuity spaces.
What about instruments? That also seems strong.
Yeah, instruments grew 11.5% in the U.S. organically, boosted by what they call surgical technologies. Think Neptune for waste management, SurgiCount for tracking sponges, smoke evacuation, things like that.
The less glamorous but essential operating room stuff.
Right, stuff that improves safety and efficiency. Hospitals need these kinds of products.
Okay, but there was one area within MedSurg that seemed a bit softer, the medical segment in the U.S.
That's right. U.S. medical grew 6.5% organically. It pulled the overall segment average down a bit.
Any reason given for that? Supply chain again.
Yeah, they pointed to timing issues and some lingering specific supply chain hiccups affecting their emergency care business. But here's the key thing. Management didn't seem worried about the underlying demand.
They expect it to bounce back.
Very much so. They reiterated that they still expect the full medical segment to deliver 10% organic growth for the full year 2025.
Which implies a really big Q4 for them.
Exactly. They seem confident that orders for things like hospital beds, stretchers, and their Vocera communication systems are strong, and maybe some delayed purchases are just landing in Q4.
Okay, that makes sense. A good reminder to look at the full year picture, not just one quarter's bump. Let's pivot to M&A now. Stryker's always active there.
Yes, and their strategy seems pretty consistent, balancing these big, potentially transformative deals with smaller, bolt-on acquisitions. Let's start with the big one, Inari Medical. How's that integration going?
Seems like it's progressing well. The Inari business itself delivered double-digit pro forma organic sales growth.
Right, driven by strong procedure growth, like in the teens. Can you just quickly explain pro forma for anyone listening?
Sure. Pro forma just means they calculated the growth as if Inari had been part of Stryker for the same period last year. It helps compare like for like, shows the underlying business momentum.
Got it. But there is a headwind there, right? Something about destocking.
Yeah, customer destocking. Basically, hospitals using up the Inari inventory they already had on shelves instead of placing big new orders. Stryker expects that to be a drag on reported sales probably through the end of Q1 2026.
Okay, so temporary inventory issue, but the actual usage, the procedures are growing nicely.
Seems that way. And they also mentioned positive feedback on Artix, which is Inari's first product for arteries, not veins, performing as expected.
Good. And the big prize for Inari under Stryker is international expansion, isn't it?
That's the plan. They're targeting the second half of next year, so Q2 2026 onwards, to really leverage Stryker's global footprint. That was a major rationale for the deal.
Okay, so Inari integration is on track. Now, what about those smaller deals? The tuck-ins they did in Q3. I found those really interesting.
Me too. They seem very strategically smart. The first was Guard Medical, which makes something called NP-Seal.
Right, a simplified negative pressure wound therapy device. Why is this such a good example of their tuck-in strategy?
Well, 2 key things. 1, it doesn't require the hospital to buy any new capital equipment. Big plus. And 2, it fits perfectly into the sales bag of their existing orthopedic instruments reps.
Ah, so the reps are already visiting the surgeons in wound clinics.
Exactly. They just add this new high-margin disposable product to their pitch. It's immediate leverage of their existing sales channel with minimal disruption or cost for the customer. Pure upside.
Very efficient, low cost, high leverage. Okay, and the second tuck-in?
That was a company called Advanced Medical Balloons. They make products for the Sage business, specifically tackling fecal incontinence.
Fecal incontinence. That sounds like a totally new area for Stryker.
It is, and that's the strategic importance. It's a small deal, but it gives them entry into a completely new market adjacency. addressing an unmet patient need, likely leveraging Sage's existing call points in hospitals.
So these tuck-ins are either deepening their bag in existing channels or opening doors to entirely new markets. Very clever.
And it reinforces their message. M&A is still priority number one for capital. They've got the balance sheet, they've got the pipeline, they're ready for more deals, big or small.
They certainly sound ready. Okay, before we wrap up, we have to circle back to those headwinds, specifically the tariffs. How big of an impact are we talking?
It picked up noticeably from Q2. The estimate for the full year 2025 net impact is around $200 million.
$200 million. That's substantial.
It is. And they basically said that's the main reason their margin expansion isn't even higher in Q4. It's a direct offset.
Okay, so $200 million headwind. But then how is the broader hospital spending environment holding up against these kinds of global cost pressures? Are hospitals pulling back on capital equipment?
Seems like the opposite, actually. This was maybe the most bullish signal in the whole call. They explicitly stated the hospital CapEx environment is strong.
Why? What's driving that?
They said hospital balance sheets are generally healthy, leading to strong demand, especially for products that generate revenue or improve efficiency.
And they had proof points for this.
Yeah, two big ones. First, they exited Q3 with an elevated order backlog for capital equipment. Demand is outstripping their immediate supply or installation capacity.
Okay, strong backlog. What else?
This was really interesting. They noted that a significant number of Mako sales in Q3 were outright cash purchases by hospitals.
Cash, not leases.
Right. Contrast that to maybe a year ago when leasing might have been more common. Buying a multi-million-dollar robot with cash suggests hospitals see it not just as an expense, but as a core profit-generating investment.
That's a very powerful signal about how hospitals view orthopedic robotics now. Mission-critical infrastructure.
Absolutely. So let's try to synthesize this. What does this all mean for you, the listener? The big picture seems to be Stryker maintaining this incredibly durable growth, near 10% for, 4 years running now?
Yeah, pretty much. And it's powered by that tech advantage, mainly Mako, but also smart, focused M&A, balancing the big integrations like Inari with those really targeted tuck-ins.
And I think the results, especially the comments on CapEx, should give you some confidence. Despite all the economic noise, hospitals are still spending, especially in core revenue-generating areas like orthopedics and minimally invasive procedures. It speaks well for the broader medtech climate.
Definitely a positive sign for the sector overall.
Okay, so here's a final thought for you to consider, especially with Stryker's Investor Day coming up on November 13th. They're clearly keeping a high bar for those huge, potentially risky mega deals.
Right.
But at the same time, they're executing flawlessly on these small, low-risk, high-leverage tuck-ins like the wound care seal or the incontinence balloon. These immediately slot into existing sales channels or open up new adjacent markets with minimal fuss.
So the question is,
Yeah, what's the better long-term value driver for a company like Stryker? Is it swinging for the fences with another massive acquisition? Or is it this steady drumbeat of hyper-focused channel-leveraging tuck-ins? Which model delivers more durable returns?
something to think about. I'm sure we'll get more clues on their long-term thinking at that Investor Day.
We will indeed. Thanks for diving in with us today.
Talk to you next time.